The outcome of the presidential election is always a matter of great interest and speculation for investors and the public alike. Many people wonder how the policies and actions of the new administration will impact the stock market and the economy in general. But is there a clear and consistent relationship between presidential elections and stock market performance? And if so, what can we expect from the next president? One popular theory that tries to answer these questions is the presidential election cycle theory, developed by Yale Hirsch, the creator of the Stock Trader's Almanac. This theory suggests that the stock market follows a predictable pattern based on the 4-year term of a president. According to this theory, the market tends to perform poorly in the first year of a presidency as the new administration faces challenges and uncertainties. The second year is usually also weak as the president implements unpopular policies and faces midterm elections. The third year is typically the strongest, as the president boosts spending and stimulates the economy to prepare for re-election. The fourth year is also positive, as the president benefits from the economic momentum and tries to avoid any major controversies. However, this theory does not always hold up in reality. There are many exceptions and variations to this pattern, depending on various factors such as wars, recessions, pandemics, geopolitical events, and other shocks that can affect the market and the economy regardless of who is in power. For example, in 2008, a controversial election year, the market dropped by 37% as the global financial crisis hit hard. In contrast, in 2017, the first year of Donald Trump's presidency, the market soared by 19% as investors welcomed his pro-business agenda and tax cuts. Another way to look at the relationship between presidential elections and stock market performance is to compare how different parties affect the market. Some people may assume that Republicans are better for the market than Democrats, or vice versa, based on their ideological preferences or perceptions. However, historical data shows that there is no significant difference between how the market performs under different parties. According to Bespoke Research, since 1900, the Dow Jones Industrial Average has gained 4.8% annually under Democratic presidents and 3.5% annually under Republican presidents. The difference is not statistically significant, and it does not account for other factors such as Congress control, fiscal and monetary policies, inflation, interest rates, and so on. Therefore, it may be more accurate to say that presidential elections have a limited and short-term influence on the stock market, rather than a lasting and decisive one. The market may react positively or negatively to an election outcome based on its expectations and sentiments, but these reactions are often temporary and fade away as other factors come into play. The market may also experience increased volatility and uncertainty in the months leading up to an election, as investors try to anticipate and adjust to different scenarios. However, these fluctuations are also normal and do not necessarily indicate a long-term trend. In conclusion, presidential elections are important events that can have some impact on the stock market and the economy in general. However, they are not the only or even the main drivers of market performance. Investors should not base their decisions solely on who wins or loses an election, but rather on their own goals, risk tolerance, time horizon, and diversification strategy. By doing so, they can avoid emotional reactions and stay focused on their long-term objectives. How investors and traders can hedge their risks and diversify their portfolios in anticipation of potential volatility and uncertainty. The upcoming presidential election is likely to have a significant impact on the financial markets, as different policies and agendas could affect various sectors and industries. In such a scenario, investors and traders need to be prepared for any possible outcome and protect their portfolios from market fluctuations. One of the main tools to reduce market risk is diversification, which means spreading your investments across different asset classes, such as stocks, bonds, commodities, currencies, and alternative investments. By doing so, you can lower the correlation between your holdings and reduce the overall volatility of your portfolio. For example, if one sector or industry suffers a downturn due to a policy change, you may still benefit from another sector or industry that performs well under the same circumstances. Another tool to hedge your risks is to use options, which are contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a specified price and time. Options can help you to profit from both rising and falling markets, as well as to limit your losses in case of adverse price movements. For example, if you own a stock that you expect to rise in value, you can buy a call option that gives you the right to buy more shares at a lower price in the future. This way, you can increase your exposure to the upside potential of the stock without investing more money upfront. On the other hand, if you own a stock that you expect to fall in value, you can buy a put option that gives you the right to sell your shares at a higher price in the future. This way, you can protect your downside risk and lock in your profits before the stock declines. A third tool to hedge your risks is to use the Volatility Index (VIX) indicator, which measures the implied volatility of at-the-money calls and puts on the S&P 500 index. The VIX is often called the fear gauge, as it rises during periods of increased volatility. Generally, a level below 20 indicates low volatility, while a level of 30 or above is very volatile. Investors can use the VIX to gauge the market sentiment and anticipate potential swings in prices. For example, if the VIX is high, it may indicate that investors are nervous about the election outcome and expect large price movements. In this case, investors may want to reduce their exposure to risky assets and increase their allocation to safe haven assets, such as gold or treasury bonds. Alternatively, if the VIX is low, it may indicate that investors are confident about the election outcome and expect stable prices. In this case, investors may want to increase their exposure to growth-oriented assets and take advantage of market opportunities. By using these tools and strategies, investors and traders can hedge their risks and diversify their portfolios in anticipation of potential volatility and uncertainty caused by the presidential election. However, it is important to remember that hedging and diversification are not foolproof methods and do not guarantee positive returns or eliminate losses. Therefore, investors and traders should always conduct their own research and analysis before making any investment decisions.